morning. Thanks so much for taking the time out. What a time it's been as far as markets in 2016 are concerned. Sharp cuts coming in, but now you're seeing some bit of recovery. What's your analysis? What's your reading of the situation as far as equity markets are concerned?
Look, I mean, equity markets have been very volatile, and I think the trend is still very much to the downside. When you had this very sharp correction in January so far this year, you're bound to see some of these counter-trend rallies. The real question is it a tradable bounce, or is it what is sometimes called a dead cat bounce? I think from a sort of longer-term investor's point of view, what you would like to see, more lower volatility and more sideways movement. These movements like in Tokyo on Friday, 6% up, 9% up in oil prices to some extent are a little bit worrying. I don't necessarily think we have seen the end of the sell-off yet. There are very sharp rallies like this, but I think the longer-term trend most probably is still down.
So, Michael, I remember talking to you a couple of weeks back, and you're probably the first voice who actually saw this kind of a crack coming in as well. Because I remember when we were in 2015, towards the end, somewhere in December, we were talking, and you said that no one's talking about a recession, no one's talking about the market somewhere seeing a lot of profit taking as well in early 2016. So, well, that's what's played out right here when we talk about the way the markets have eroded. The point here is, do you still see further downside, and if so, how much more pain probably is left from the current levels?
I mean, that's a very good question. But look, I mean, if you look at the long-term charts, I still think that, for example, let's talk about the U.S. equity market. I think that the May 2015 high of 2,135 potentially could be a multi-year high. So the question is how much more downside we have. If you believe that that is the all-time record high, potentially there's more downside than people are pricing in. And I think what's also important is that whole question and debate, rather, whether we potentially could see a recession. I mean, it's not just very much the China story that everybody talks about, but I think the bigger question is, and I think your central bank governor, Mr. Rajan, I think he made that point best in Davos a few days ago, saying, look, according to Mr. Rajan, the real story is that quantitative easing trade potentially is becoming less meaningful, less powerful. I think a lot of that ammunition has been used, and now you're in a situation where central banks increasingly are running out of ammunition, or at least it's not as effective as they used to be, while at the same time the debt levels are very high. And, for example, during the United States subprime crisis, right, the Fed balance sheet at that time apparently was $800 billion. Now the Fed balance sheet is $4.5 trillion. So you could argue that even the Fed increasingly has an issue with its balance sheet. So the question is whether Japan and Europe will do more quantitative easing, when some people have pointed out that, look at the European markets, they're now below the levels of when quantitative easing has started. So I think the market is not just focusing so much on China. The real story is that quantitative easing trade becoming less effective? And if that's the case, then most probably, yes, we could see significantly more downside.
So then the flip side to that, Michael, is also a situation out here where, this is actually coming in from Davos itself, where a couple of our colleagues from Bloomberg were in conversation with some top heads who look at the Western economies quite closely, and some of the management from the top heads of Chinese economy as well. And there was a constant debate out as to whose fault really it was for this entire erosion that we've seen in the markets. So somewhere, the fingers are constantly being pointed towards the Chinese economy, but that's been a problem that's been on for some time now. So is it more to do with the kind of Fed tightening that we'd seen in sometime in December? Is that the main culprit? Is that a major role out here to this entire erosion that we've seen?
Look, I think it's a very good point, and I think it's a combination of these two things, but also, I suppose, the fact that it's the Chinese, of course, obviously get a lot of blame for this, and maybe they made some policy mistakes, but I suppose the real issue is global debt in the world. I mean, global debt in the world has skyrocketed, right? Maybe because we had interest rates that were too long for too low, and now you have an environment where, yes, the United States central bank is sort of trying to normalize monetary policy when many people maybe have borrowed too much. And I think that credit cycle potentially could turn. And I think this is already what we're seeing among the rating agencies, that the rating agencies are becoming more cautious in their outlook. I mean, we're seeing more downgrades. So I think potentially we could see credit losses going forward. And I think that to some extent potentially could put further pressure on both equity markets but also on corporate bond spreads.
Michael, it's interesting that you talk about the way some of these central bankers' commentaries been panning up because, even as we were talking earlier about this rebound that the markets have taken place, it's somewhere coincided or probably a result of the way the commentaries really played out. Maybe on one hand, what Mario Draghi actually had to say, or on the other hand, what the BOJ action also really played out, and that huge rally that we'd seen in the Japanese market. So the point here is, if we were to see some bit of less hawkish or some bit of dovish commentary coming in, probably from the Fed this week, or for that matter, over the next couple of weeks itself, would you then anticipate the markets to once again picking up some momentum?
Maybe less. Yeah, look, I mean, I'm personally of the opinion that we could see this year maybe 20 to 30% declines in U.S. equity. So the equity market in the U.S. and the S&P 500 could potentially go to 1,650 levels. I mean, India's Sensex potentially could go down to 20,000. I think we're at the end of this expansion cycle, if you will, and it's led by cycle. But I suppose playing the rebound potentially is only for short-term traders. As a longer-term investor, you might want to use these very sharp rebounds in order to reduce equity positions and also to some extent buy some more portfolio insurance. In terms of portfolio construction, I think investors are well advised to consider long-short strategies because there are a lot of very conflicting forces. That's why there's a lot of confusion as well, a lot of noise in the market. But I think the longer-term trend for global equities and risk assets potentially could be lower. And unfortunately, many people are still not prepared for this.
So, Michael, what you're basically saying is that there could be more outflows coming in when we talk about emerging markets. We still haven't seen the worst of it when we talk about the setup as far as China or, for that matter, India is concerned?
Correct. And I think, many people speak about China, but I think the bigger, as well as important as China, I suppose, is the whole Middle Eastern story, this whole question about Saudi Arabia. If you look at the year-to-date, on your Bloomberg screen, if you look at the world's worst-performing market, apparently Saudi Arabia is among the world's worst-performing markets. And I think the Middle Eastern countries, like Russia, at the current oil price, will have serious budget problems, and potentially some of their sovereign wealth funds also have been net sellers of Western assets. So I suppose that sometimes it's called this global tightening process, I think is happening, and that potentially could put further pressure on global asset prices. So I think we have not really seen the end of this, and I think usually when a cycle like that starts, it usually has more room to go. In between, there are very sharp rallies, but I think the longer-term direction tends to be down. And when you look at your Bloomberg screen and the Bloomberg terminal, when you do technical analysis, a lot of these markets still fundamentally look weak. And especially a longer-term time frame on a monthly and a quarterly chart, increasingly they all look bearish.
The other aspect of this is the way the oil prices were starting to rebound as well. Again, possibly on the back of the commentary that we picked up and what we were talking about earlier as well. But is there a certain level to your mind as to where you possibly say that the trend somewhere reversed for oil prices? Because the last 2 or 3 sessions, the oil prices have seen a decent rebound. You got the Brent once again hovering about the 30 to 33 odd level is what we're seeing currently as well. So is there a certain level to your mind where you would say that the trend, the downward move that we'd seen in oil prices may have somewhere reversed?
That is exactly the question. I suppose when you look at oil, I think there are 2 big dimensions here. The question is it a demand issue, global growth is slowing, or is it actually too much supply? And currently most people tend to focus on the supply issue, that there's too much supply, and it's the so-called beggar labor theory. The Iranians potentially sell more oil, the Russians trying to sell a lot of oil, Saudi tries to crush the shale producers in the United States, so everybody seems to supply a lot of oil and demand is holding up, so supply is very much outstripping demand, so oil prices are going lower. And I potentially could see around $25 on oil before we're bottoming out. And I think also what is interesting or important to see from a price action point of view is that we should ideally see more of a bottoming out phase that is lower volatility but more sideways to up again. I think this very sharp move, 6% down, the next day 9% up, potentially is actually worrying. It's not a sign that this market is bottoming out. It's a sign that potentially we could take another leg down. And that leg down potentially could be around $25 a barrel on WTI.
All right, Michael. Thanks so much for taking the time out today and sharing your thoughts and perspective and stopping by our studios in Singapore. Michael Preiss there sharing his views as far as global markets are concerned and what he's looking at when we talk about a strategy as far as India is concerned as well. Calling probably 20,000 as a level that the Sensex would possibly touch and 2016 to be somewhat of a tough year. All right, just a quick check once again as far as